Guidelines for first-time startup investors. If you have some disposable cash, you can invest it in a variety of ways. Besides such traditional instruments as stocks, bonds, and mutual funds, you can put your money to work in an alternative type of investment, startups. Doing your homework beforehand and using the guidelines referenced in this show can help you increase your chances of landing a good deal for your portfolio. Welcome back, folks, to another edition of Sweetie Kiwi. I hope you are doing fantastic. I'm doing fantastic today, and if you're doing as great as I am, go grab a cup of coffee or tea or vodka. Let's roll. But before I get into the nitty-gritty, I want to give a shout out to Lucas Ritter in Bellevue, Nebraska, Elisa Dunn in Grand Island, Nebraska, and Lucador in Papillion, Nebraska. So we give a shout out. We give shout out to our millions of viewers and listeners in the United States and beyond. Thank you so much for your support. So one thing that I want to say before we talk about the guidelines is that make sure you're ready to invest in startups before taking the leap, right? Because this is very important in terms of analyzing your risk profile and making sure you can actually hedge against any potential losses that might come your way. Now, the first guideline, have disposable income. I'm talking about startup capital. You need to have it. This should be in a savings account. Don't try to break your IRA or your other retirement account to extract the money from there to be able to finance a startup, unless that's what you want, right? If that's what you want, then yes, then you can transform this. You can transform your IRA into a self-directed IRA, in which case you'll be able to invest in the startup. So usually the best source of the income when it comes to first-time startup investors is savings. So you have a saving, or you have a certificate of deposit, a CD, or a money market account, anything that is liquid, any asset that is liquid where you can get the cash ASAP. That's really good. So you need to make sure you have that money ready before you even consider a startup. It is very important, because if you don't have the cash and you have to back out at the last minute, this will give you a bad reputation in the startup community. And it's a very tight community. I'm not even talking about Silicon Valley. I'm just talking in general. It's a very tight community. Those founders, they hang out, they network, they know each other, they know all the stories. So stories will travel about you. So that's a big no-no. You don't want that. So have the money available. Get to know, that's number 2. Get to know the startup universe. It's very important to understand that a lot of the vast majority of startups fail within 3 years, according to the United States Small Business Administration. The SBA estimated that up to 90% of more than 90% rather of startups failed within the first 24 months, so 2 years. Right. So the SBA said that more than 90% of startups fail after 2 years. All right. So you got to really understand that this is a highly risky prospect here. So, of course, they attract investors because the potential rewards are high. So you have to understand that. So you have to know the failures. You also have to know the reason why a startup might fail. There's something called execution failure. So they couldn't really execute based on their strategy, or adoption challenges, right? So this also depends on how they feel and if the market is ready to adopt their particular products. Another thing you need to do is you need to understand startup risk and diversity. This is very important. As I said earlier, the majority of startups fail. So you want to make sure that you are able to put different eggs in different baskets. Never put all your money, never invest all your $1 million or your $100,000 into one startup, right? So diversity is just great. I'm talking when it comes to portfolio management in general, right? And it's also the most important aspect for any investor to keep in mind when managing risk. And as a startup investor, knowing the risk that surrounds that type of company, you want to manage risk, right? This is just a big element in your strategy. All right. Now, another thing you want to do also is that you want to, when it comes to risk and diversity, you want to first understand your own risk profile. You want to know your own, whether you are a risk taker or a risk averse person. Knowing that profile will help you approach the whole investment situation differently, and will help you also identify and pinpoint those startups that correspond to your investment criteria. All right, I'll be right back right after this. Do not go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're still having a conversation today about the guidelines for the first-time startup investors, and I want to quickly give a shout out to Salt Fried Harrison in Sandy Springs, Georgia, Norella Imbo, Dunwoody, Georgia, and Emenegil Pichi, that's in Roswell, Georgia. Thank you very much. We really appreciate your help. Thank you for your suggestions. And if you've just been listening to us for a while and you love the content of the show, consider subscribing to our channel and turn on the notification bell so you can receive all our info in real time. All right, number 4. Help your startup by providing connections or being a mentor or advisor, right? I mean, when you put money in a startup, that's pretty good. They need the cash, right? But don't limit your commitment only to the financial aspect of things, right? You can actually help out. You can help a startup through other means, right? So if you have an expensive professional network, if you have a wide professional network, consider tapping into it and refer some of the members to the startup you just want to invest in, right? Because and if you really watch the financial news, you can see that a lot of angel investors, this is how they're called. People who invest in startups at the initial stages, they're called angel investors. So if you want to become an angel investor, just make sure that you're able to surround yourselves with the right people, but also directing those people to the company, right? So this is very important. Understand the exit strategy. So you want to know, by exit strategy, we talk about how an initial investor can recoup his or her money in a startup. So, and there are several strategies to have an exit. You can have a merger, an acquisition, an offering. You can also have a sale. So basically, the thing here is that you, as an investor, as an angel investor, you want to know the risk and rewards, right? If the company, the startup has to file an IPO, this could be a good payday for you. And the whole thing here is that you have to know beforehand whether you want to sell or whether you want to keep the stock for a long run. But yeah, this is the kind of conversation and thinking that allows you to know exactly whether this company you're considering is the right company for you. All right, so understand the exit strategy. Now here we're talking here about the last guideline here is hold your breath. You got to be patient, right? Because as I said, the failure rate in startups is very high. So once you put your cash to use, don't call the founders every day or every quarter, every month. No, give them space, unless and if they have appointed you as, say, an advisor or a mentor to one of the founders or co-founders. Otherwise, you want to be patient, right? Because there's no guarantee you'll receive your investment back, right? So these things take years. If you think about Facebook back in the days, or Google, those GAFA, which once were very tiny, think about how long it took their investors to recoup their cash. But now they're just relaxing. They are having fun because it was worth it. The wait was worth it, right? So just make sure that when it comes to startups, things could take up to 10 years to materialize, right? So you make sure you have a significant time commitment in your mind in terms of your goals for the next 10 years, if that's what you want. All right, I will talk to you right after this, and go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We are about to wrap up today's conversation, and I'm very glad to still have you around. Please consider subscribing and turning off the notification bell if you haven't done so. And please share, comment, and like our show. We really appreciate it. I want to give a quick shout out to some of our loyal fans and listeners who have given us shout out also. So we just returned the favor. So we have Alfred Cordia, and that's in Alton, Alaska. Brother YouTube, that's in Anchorage, Alaska, and Edelston Genpede, this is in Juneau, Alaska. So the guidelines for first-time startup investors are pretty simple. Have the disposable income, get to know the startup universe, understand startup risk and diversity. Help your startup by providing connections or being a mentor or advisor. Understand the exit strategy. Hold your breath. All right, so this is basically it for today. And before I wrap up, I just want to give you a pro tip. Now you have to understand that the startup investment universe has gone through some changes lately. Before, you had to be you have to be a sophisticated investor, what they call accredited investors, to get into startups. Now, a few years later, the government realized that they wanted people to participate in the economy, and one way was to allow people to buy companies they were interested in. So they sort of loosened up the rules on that. So nowadays you can actually invest directly into a startup. All right, I'll be right back. No, I'm not right back. I'm just wrapping this up. Thanks for listening, folks, and I will see you next time. Until then, stay marvelous.